The United States national debt has expanded by over $800 billion in the first quarter of 2026 alone. This relentless surge in fiscal liability functions as a massive gravitational well pulling the global financial system toward a new monetary equilibrium. Financial markets currently observe a significant technical consolidation at the $83 level for silver spot prices. The chief analyst identifies this price point as the final bastion of Western paper market dominance. Institutional desks in New York and London have utilized high-frequency algorithms to defend this $83 ceiling throughout the month of March. However, the structural integrity of this defensive perimeter is being eroded by a massive migration of physical metal to the Eastern Hemisphere. The Shanghai Gold Exchange and the People Bank of China have emerged as the primary drivers of global silver price discovery. Tomorrow at 6 p.m. Eastern Time, the Asian markets will initiate a trading session that is expected to dismantle the current price suppression. Wall Street is currently holding a record net short position on the COMEX exchange to facilitate speculative trading. This short position represents a promise to deliver metal that simply does not exist in the registered vaults of the West. The analyst notes that the physical inventory in London has reached a 20-year low, while Shanghai inventories continue to climb. This divergence in physical holdings creates a massive arbitrage opportunity for Eastern institutional buyers. The $83 level is being viewed in China not as a ceiling, but as a discounted entry point for strategic reserves. Industrial demand within the Chinese manufacturing sector has surpassed all previous 2025 projections. The rapid expansion of the lunar energy program and advanced satellite telecommunications requires vast quantities of high-purity silver. The chief analyst observes that the Chinese government has categorized silver as a critical strategic resource for national security. This classification means that the Asian superpower is willing to pay premiums well above the Western spot price to secure delivery. The Sunday evening opening at 6 p.m. is the moment when this physical demand hits the global electronic platforms. Institutional sellers in the West are often caught in a liquidity vacuum during the first hours of the Asian session. A massive buy order from a major Chinese state bank can move the market by several percentage points in seconds. The $83 mark is expected to fail because it is based on paper leverage rather than physical scarcity. The analyst explains that the silver market is currently experiencing a decoupling of price and value. The Western paper price reflects speculative sentiment, while the Eastern physical price reflects industrial reality. Tomorrow at 6 p.m., the reality of the Eastern physical market will override the sentiment of the Western paper market. Wall Street hedge funds are currently trapped in a weekend blackout while the Asian trading desks prepare for an aggressive open. The chief analyst suggests that the $83 break will trigger a cascade of buy orders from momentum algorithms. These algorithms are programmed to chase breakouts regardless of the underlying fundamental cause. The resulting surge in volume will likely bypass all existing stop-loss orders held by the short sellers. This is the mechanical definition of a Sunday gap up that leaves the bears in a state of total liquidation. The analyst emphasizes that the Chinese middle class has shifted its investment preference from real estate to precious metals. This retail participation in the Shanghai market adds a layer of persistent buying pressure that the West cannot match. Gold has already achieved record highs in 2026, and silver is now following the same trajectory. The gold-to-silver ratio has begun to compress as the market realizes the extreme undervaluation of the white metal. A return to the historical mean of 15-to-1 would imply a silver price far exceeding $83. The chief analyst observes that the Federal Reserve has limited options to combat this rising commodity inflation. Higher interest rates would increase the cost of servicing the massive U.S. national debt to unsustainable levels. This fiscal trap ensures that the real interest rates remain negative, which is the perfect environment for silver. China is utilizing this window of Western fiscal weakness to solidify its control over the global silver supply. The $83 level is the last line of defense before a move toward triple-digit valuations. The analyst notes that the cost of production for new silver mines has increased to $65 per ounce. This high production floor means that a drop in price is unlikely, while a spike in price is inevitable. The physical metal is being treated as the ultimate safe haven in an era of escalating geopolitical tension. Tomorrow at 6 p.m., the world will see the first major break in the old financial order. The Sunday slaughter of the shorts will begin with a simple electronic signal from Shanghai. Wall Street is terrified because they no longer control the narrative or the physical metal. The chief analyst maintains that the 80s were the decade of debt, while the 20s are the decade of hard assets. Silver is the leading edge of this transition, and the $83 break is the signal. The second phase of the institutional transition involves the total revaluation of the industrial silver supply chain. Modern high-tech manufacturing in the Asian superpower bloc is consuming silver at a rate of 100 million ounces per month. The chief analyst observes that the previous reliance on recycled silver scrap has reached a point of diminishing returns. Primary mine supply is the only way to satisfy the growing appetite of the solar and semiconductor industries. China has secured long-term offtake agreements with major silver producers in South America and Africa. These agreements effectively remove physical silver from the Western exchanges before it can even be listed. The $83 spot price on the COMEX is increasingly irrelevant to the actual wholesale trade. Tomorrow at 6 p.m., the Shanghai Gold Exchange will reflect a price that accounts for this global physical tightness. The chief analyst explains that the silver market is currently in a state of backwardation in the Eastern exchanges. Backwardation occurs when the spot price is higher than the future price, which signals an immediate need for physical metal. In the West, the market remains in contango, which indicates that paper speculators are still in control. This divergence between the two regions creates a massive pressure cooker that will explode tomorrow evening. Wall Street desks are aware of this pressure, but they are constrained by their own massive short positions. They cannot buy back their shorts without driving the price into a parabolic spike that would bankrupt their trading partners. The chief analyst notes that the Chinese central bank has been a silent buyer of silver for over 24 months. They are utilizing their massive US dollar reserves to acquire tangible silver at what they perceive to be bargain prices. By breaking the $83 level, China is effectively devaluing the paper claims of the West. This is a strategic move to reset the global financial system in favor of commodity-producing and holding nations. The analyst observes that the retail demand for silver in the United States is also reaching a boiling point. American investors are seeing the record highs in gold and are rushing to secure silver before it becomes unaffordable. This synchronized global demand is meeting a supply that has been stagnant for nearly a decade. Silver mining is often a byproduct of lead and zinc and copper mining, which limits the ability to increase production. Even at $83, many mining projects are facing regulatory and environmental delays that prevent expansion. The chief analyst suggests that the market is entering a phase of permanent physical deficit. Tomorrow at 6 p.m., the Asian Open will provide the first real test of the Western exchange's ability to deliver. If the gap up is large enough, it could trigger a force majeure event on the paper exchanges. A force majeure occurs when the exchange declares it cannot fulfill its delivery obligations and settles in cash instead. This would lead to a total loss of confidence in the paper-silver market and a move to a purely physical system. The analyst observes that the Chinese are already building the infrastructure for this new physical system. The Shanghai Gold Exchange is the largest physical bullion exchange in the world by volume. They have the warehouses and the delivery mechanisms already in place to handle the global trade. The $83 level is the final psychological barrier to this transition of power. The chief analyst highlights that silver is the essential ingredient in the artificial intelligence revolution. The vast data centers being built across the globe require silver for their cooling systems and high-speed circuitry. This new pillar of demand was not accounted for in most institutional models from 3 years ago. Wall Street is currently playing catch-up to a reality that the Eastern markets have already priced in. The analyst notes that the volatility during the Sunday Open will be extreme as the algorithms fight for liquidity. Traders who are caught on the wrong side of the $83 break will have no exit until Monday morning. By then, the price could be $5 or $10 higher as the short squeeze intensifies. The chief analyst maintains a strictly authoritative view that the $83 reversal is a mathematical certainty. The data on physical flows and industrial consumption points to a single inevitable conclusion. The era of cheap silver is ending tomorrow at 6 p.m. Eastern Time. The world is moving from a world of infinite paper to a world of finite metal. The final stage of the global silver revaluation involves the total capitulation of the Western banking system. Historically, the largest financial institutions in the United States have acted as the primary gatekeepers of the silver price, utilizing their massive balance sheets to suppress price spikes and maintain a facade of order in the global currency markets. By flooding the market with paper silver, futures contracts, and derivatives that far exceed the actual physical metal in existence, they manage to keep prices artificially low to protect the dominance of the US dollar. However, the sheer weight of Eastern physical demand has finally become too heavy for even the most powerful Western banks to carry. Tomorrow at 6 p.m., the final resistance level at $83 will be tested by an unprecedented wave of sovereign buying power that signals the end of the paper manipulation era. The chief analyst observes that the Chinese yuan is increasingly being used to settle major commodity trades throughout Asia. The chief analyst observes that the Chinese yuan is increasingly being used to settle major commodity trades throughout Asia, a strategic move that systematically reduces the ability of Western banks to influence prices through currency manipulation. This shift away from the dollar is a clear signal to the rest of the financial world that the era of unipolar dollar dominance is fading. Institutional investors in Europe and the Middle East are watching the $83 level with intense interest, recognizing it as the line in the sand. Once this breakout is confirmed, a massive wave of capital is expected to flow into silver as the ultimate inflation hedge. Because the total market capitalization of silver is so remarkably small compared to other asset classes like gold or stocks, this inflow will be explosive. Silver is currently the smallest major asset class, which makes it uniquely prone to vertical parabolic moves once the floodgates open. The Sunday slaughter of the shorts will represent the first time in over 20 years that the paper market has completely lost control to the physical reality of the streets. The $83 level is mathematically identified as the point where major short sellers become insolvent. As the price moves past this barrier, these institutions will be forced to buy back silver at any price to close their hemorrhaging positions, creating a massive vacuum of sellers. This is the historic moment when physical holders will see the true value of their investment realized. The analyst predicts that the premium on physical silver eagles and bars will likely jump to 50% or more, indicating that the paper price is desperately trying to catch up to the reality of physical scarcity. This $83 break is the sound of the starting gun for the final lap of the silver bull market, with a target of $150 by the end of the year. This forecast is grounded in the historical performance of precious metals during periods of currency reset and high systemic inflation. Interestingly, a younger generation of investors is treating silver like a digital asset with a physical backup, valuing its absolute scarcity and its critical industrial utility in the green energy and artificial intelligence revolutions. Unlike previous generations, this new base of strong-hand investors is unlikely to sell during initial price spikes, which will keep the available supply tighter than ever before. Silver is now recognized as the essential ingredient in the artificial intelligence revolution. The vast data centers being built globally require immense amounts of silver for high-speed circuitry and advanced cooling systems, a pillar of demand that was completely unaccounted for in institutional models just 3 years ago. As a result, the market is entering a phase of permanent physical deficit. Mining companies are already seeing a massive surge in their stock prices, acting as the early warning system for the move in the underlying metal. Silver cannot be printed, debased, or easily manufactured. It must be pulled from the earth at great expense, and current production is stagnant. Tomorrow at 6 p.m., the truth will be revealed in the form of a massive green candle on the global charts. The power has shifted to the east, and the physical metal has reclaimed its throne. For anyone holding paper silver claims, the risk of a total market shutdown or a mandatory cash settlement is real and must be accounted for. Holding physical metal is the only guaranteed way to participate in this coming revaluation. The $83 silver price is a relic of the past that will be shattered by the new reality. Those who are prepared will see their wealth protected and grown, while those who remain tethered to the old banking system will be left behind in the dust of the greatest silver rally in history.